Vanguard thinks investing is about to change, and they outline their reasons for why they feel like this in this paper right here. It's a discussion on a fight that has been raging since the 1920s. So epic is this battle that many investors will pick one side or the other and then follow it with the same level of passion that they would have for a football team. But for the last 10 years, one of these sides has had the other beat hard. But Vanguard are coming out and placing their bets on an old-timer who's been down and out for some time now, making a massive comeback. Let's start by setting the scene. It's February 5th, 1943. The Olympic Stadium in downtown Detroit is filled to the rafters. Packed with spectators all itching to see a fight between two of the best boxers of all time, Sugar Ray Robinson and Jake LaMotta. It's the 8th round and Sugar looked in control up until this point, but LaMotta's come to life, and what happened next must have had the Olympic Stadium in rapture. Jake steps forward and with a devastating right to the body and left to the head, knocks Sugar Ray Robinson clean out the ring. With his back on the cold hard floor of the Olympic Stadium facing up at the ring, Robinson was only saved from a certain KO by the bell. But the luck wouldn't last long for Robinson, as Jake would go on to win this historic fight by unanimous decision. If you'd only ever watched that fight, you might be excused for thinking that Jake the Raging Bull was the better fighter, and if you had to place a bet on who would win next time, you'd probably bet on Jake. But these future Hall of Famers faced off 6 times in their careers, and February 5th, 1943 is the only time Jake would ever claim victory. For this video, our comparison is between 2 Hall of Fame investing styles, 2 of the best pound-for-pound investing strategies that you could have ever put your money into, and the epic battle that they've had over the last 100 years. Value versus growth investing.
Some very common labels in investing. It's everywhere. In fact, there's Morningstar styles.
And the difference couldn't be simpler. Value, as the name suggests, is the investing strategy of focusing on companies that are undervalued by the market, basically finding businesses that are selling at a discount. Growth is the focus on businesses that have the potential to grow a lot in the years to come.
Darling, I'm a grower, not a shower.
Think of Warren Buffett buying a bank versus Cathie Wood buying Tesla in terms of the difference between investing strategies. Now, while I'm sure a lot of us would pay very good money to watch Warren Buffett fight Cathie Wood, I personally think that Cathie would kind of have Warren beat nowadays. Warren's getting on a bit, and Cathie seems to have mastered the 5-finger exploding heart technique that was popularised by Kill Bill. If I asked most new investors what investing strategy was going to dominate in the next decade, I bet most of them would say the sexy growth companies that dominate the S&P 500 in America. And can you blame them? Because when we picture the future, we imagine self-driving Teslas and the metaverse, not banks and washing up liquid.
Well, I need it now.
In the last 10 years, growth has absolutely battered value investing. But don't just watch one fight and then think the outcome's always going to be the same. These two have had it out multiple times, and the results have always been pretty one-sided. According to Bank of America, since 1926, value investing has returned about 1.3 million%. During the same time, growth investing returned about 626,000%, half the returns. In fact, this table on screen produced by Vanguard demonstrates the dominance of value investing. The middle line is the crossover point. Anything on the top half means value outperformed. We can see the graph started in 1936, and the whole way along, a younger Warren Buffett and his value investing would have slapped the Googles out of Cathie Wood's growth approach, reducing her to Palantir's. And then, everything changed.
Shares were just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate.
2.5 for a money market account. I mean, how low can you go?
Interest rates have been at historic lows since December 2008.
The tech landscape has changed dramatically over the past decade.
This culmination of factors has meant that growth has absolutely dominated in the last decade, leaving value investors flat out on the floor looking up at the ring wondering what the hell happened.
Who that? Who there?
But is it time for a comeback? Let's pick apart this Vanguard study and see what they are arguing here and if we all need to be investing differently as a result. I'm also going to reference some other studies in this video, and I'll link them all below for you.
As of course is tradition.
But all of the conversation on this topic essentially focuses on the factors that have driven growth stocks forward, and those factors now turning against them. Let's start with low interest rates and inflation. A company's stock price today is a reflection of its expected future earnings. Basically, we pay a price for a share of a business today in order to secure its future earnings. We buy into that business in the hope that it makes a load of money, and then our investment goes up in value as a result. With growth investments, the expectation is that that business will produce a lot of income in the future, but isn't making much at the minute. So as investors in growth companies, we pay for that future growth with the expectation it might take a little while to actually get the investment back. With value investing, the nature of the investment means we may not see high levels of growth, but we see a quicker return on our initial investment due to the lower price point relative to earnings. Basically, the business is already making money and can be picked up at a good price, versus, say, a business that could potentially one day dominate its sector and make loads of cash, but at the minute is losing money because it's heavily reinvesting in itself. Now, inflation is the destruction of value over time, and the concept that in a few years, the pounds or dollars we have in our pockets will buy less stuff. In a high inflation environment, value stocks' ability to return on investment sooner makes them more valuable to investors. You know the saying, a bird in the hand is worth more than two in the bush. Basically, a bird in your hand that you can use for whatever you use birds for is worth more than two birds in a bush that you can't use. Money in your hand now, today, is worth more than money in the future that you can't touch. This is a concept called the time value of money. And we see this reflected when talking about interest rates and inflation in a lot of these discounted cash flow models that people use to value businesses. Investors use discounted cash flow models to predict what future income is worth to them today, to give them a price they think is acceptable to pay for the business. If I said to you now, give me £10 and I'll give you £10 back in 10 years, you'd know that's a rubbish deal, because you know inflation is going to erode away the spending power of the £10. So by the time you get it back, you won't be able to buy anything with it. So you might go, I'll give you £8 today, Damien, and then you give me £10 back in 10 years. What you're essentially doing there is almost discounting that cash flow backwards to make it worth your while. But rather than, front loading on an interest rate, so you're saying £8 to 10, with a discounted cash flow model, you start with £10 and you work backwards so you get a figure that today you're willing to pay to secure that £10 in the future. Investors look to factor in inflation when looking at future cash flows and what they're worth to them today. But they also need to look at opportunity cost, which is often influenced by interest rates. Basically, you know that you can get a risk-free return on your cash in a bank. Now, obviously, that's not very much at the minute, but it is there if you wanted it. So you need to weigh up that opportunity cost of sticking your money in a guaranteed kind of investment versus the risk of investing in a business that has no guarantee of income and the cash flows that you're after are in the future and are assumed. In the last 10 years, we've had a low inflation and low interest rate environment. This means two things. First of all, there is no better place really to put your cash than the stock market. So the opportunity cost of putting it in the bank isn't really there to compare against because banks provide little to no interest. And secondly, because inflation hasn't been a massive concern, cash flows for growth stocks in the future have been discounted at a lower rate because investors weren't concerned that inflation was going to completely destroy the value over that period of time. What that means is, by discounting cash flows at lower rates, that means people are more willing to pay a higher price today to secure those cash flows, which means growth stocks have increased in value. When interest rates rise and there is inflation concerns, these are factors that benefit value stocks, as you get your hands on their income sooner, making them more attractive. Inflation does less damage to value stock cash flows because you're getting your hands on them sooner, immediately essentially, or next year because they're producing income straight away. Whereas these growth stocks, which are going to take years before they start earning any money, inflation erodes that spending power. The argument is people got giddy on future potential earnings of growth stocks, have paid too much, and now as inflation kicks in, those prices will look high and thus come down. I hope you're still with me after that. Let's look at something a little simpler from the Vanguard research now, shall we? Corporate profit growth. Vanguard expects the amount of money businesses make to increase in the coming years. And this makes sense in the context of everything that's been going on. A lot of traditional industries like tourism, retail or energy took an absolute pounding because of everything that's gone on, whereas tech just kind of looked perfectly placed to capitalise on everything, meaning that a lot of high growth tech companies just came out the block real quick and absolutely exploded in value. Zoom being one that comes to mind. But as the global economy recovers, a lot of these value sectors look set to have a good time. And we've seen this before with previous recessions. In a paper called Did I Miss the Value Turn?, the authors showed how in the last 6 recoveries from a recession, value stocks outperformed growth by 23%. The paper basically goes on to say that factors and forces of the last few years have led to growth stocks becoming quite expensive and value stocks looking very cheap and unloved. It's kind of like those bungee cord things where you strap around the waist and you're on like a bouncy castle and you've got to run away from the bungee cord as far as you can, and then you get so far and it just kind of snaps you back. Well, value and growth have just been running the opposite way, and this paper argues that it's only a matter of time until they return to fair value. And what that will mean is that growth stocks come down in value and value will go up. They say that there's not been this level of disparity in the prices between the two since the dot-com bubble. I'll quote the paper directly. The opportunity to buy value stocks may be short-lived, and we may wait decades for an opportunity of a similar scale. These guys think that the relative cheapness of value stocks present a massive opportunity to investors, or at the very least, the overvaluation of growth stocks means that the returns on growth companies could be less in years to come. And can you blame them when you see electric car companies that have never really made a car get valuations of $100 billion? People are buying these businesses because they expect them to change the world, but they're paying a price that implies they already have. The final factor Vanguard discusses is market volatility. When inflation is high, the stock market tends to be more volatile. This is kind of a reflection of people's uncertainty as to what's going on in the economy and how governments will react to that. When there's uncertainty and stock markets are volatile, people tend to like to put their money into more secure, predictable investments. A value business with a consistent track record for producing income can be more appealing to many investors in uncertain times than a growth business with a potential for future earnings. You already have uncertain earning potential, you then start to add more uncertainty and it kind of puts people off. Now, Vanguard are certainly sticking a flag in the ground and making some hard predictions here. They say that investors who allocate their entire portfolio to value can expect averaged annualized returns of 4.3 to 7.3% over the next decade, versus 3 to 5% for the broad US market. Vanguard's argument is based on sound logic and examples from the past. Now, some people might sit there and go, well, they're biased, they're just going to bang the value drum because it suits them. But I don't think that's the case. Their main business is index funds, and they're kind of indiscriminate in their purchases. Vanguard's prerogative really is for you to make as much money as possible, because then you're likely to stay with their funds, and the more money you have invested in their funds, the more fees they collect. You can't say Vanguard is pro-value over growth when they are the second biggest holder of Tesla shares right after Elon. Now, while biased they are not, neither are they psychic. No one has ever been that good at predicting the future, Vanguard included. They stated that international investments would outperform the US markets, and that didn't age well at all, did it? Yes, they are better funded, experienced, and more intelligent than most of us, but doesn't mean they can see into the future. I'm always going to have an allocation to innovative, cutting-edge businesses who promise to change the way we live our lives. The future is tech. I think every industry will need to continuously change over the next 40 years or face extinction in the face of fast-evolving technology and innovation. But I won't ignore the traditional sectors like banking that are ever present in our daily lives just because they are not reinventing the wheel. It can be so tempting as a new investor to think if it's not game-changing technology, if it's not shiny and new, it isn't worth investing in. But when faced with the data of the last 100 years, that could be short-sighted. Basing your investing strategy on what's happened in the last 10 years and 10 years alone is a classic example of recency bias and could be a little bit naive. Which reminds me of something that our man Jake LaMotta said from the intro. Most people aren't good or bad, they're just naive.